Hi, my name's Glenn Horn, and I'm a volunteer with CPA Canada Financial Literacy Program. I've had the opportunity to work with business owners and entrepreneurs for the past 15 years, working with their balance sheets and having them ask lots of questions. And today I get to share some of those questions with you. This presentation will be about an hour or so, and it's meant to be interactive, so if there are any questions, please feel free to stop me and ask, or there'll be time at the end of the presentation for questions as well. You'll find a copy of the presentation on your chair, as well as 4 handouts, implementation checklists, glossary of terms, compare and contrast, and basic balance sheet. If you don't have one, please, there are extra copies at the back of the room. If there are any follow-up questions that you have after the presentation, I have left my business cards at the back of the room, and please feel free to contact me at any time. So let's move right into it. Some common questions business owners ask are, what does having a healthy balance sheet really mean? How do others look at my balance sheet? What measures a balance sheet's health? And what do investors or the bank look at? And should you be in a certain situation, how do I cure that unhealthy balance sheet? Now let's take a look at these a little deeper. What is a healthy balance sheet? A healthy balance sheet shows that a company has adequate solvency or liquidity, appropriate borrowing, adequate capital, and you can look at all of these through a ratio analysis. Also, you need to look at positive trends and forecasts, which this you can look at a little bit more of a graph basis. These are some of the benchmarks for a strong financial health, and we'll take a look at each of these individually as we're going through the presentation. Why is a healthy balance sheet important? Really, this comes down to the users of the financial statements and the balance sheet. So what are they used for? Let's look at 3 different users. Business owners and shareholders. So what do they want to know? Does the company have adequate liquidity? Look at investors and lenders. What are they looking at? They're looking at your debts and whether you're able to repay those debts. Or potential partners. They may be looking at your capital and how have you deployed or used that capital within your financial statements. End of the day, everyone's looking for a healthy balance sheet because that gives them confidence in the business themselves from their own perspective. As an activity, I want to refer you to and take a look at one of your handouts called the basic balance sheet. We'll be looking at this for certain activities throughout this presentation, so keep that one handy and we'll look at that as we go through. Adequate solvency and liquidity, the quick ratio. So let's look at a definition of the quick ratio. Really, it is current assets minus inventory divided by current liabilities. It really assumes that inventory is not a current or liquid item. So your current assets may include cash, accounts receivable, or marketable securities, where your current liabilities may be debts to employees or suppliers, bank loans, prepayments, and taxes. The quick ratio is an indication to individuals whether the business has adequate liquidity. Typically, you may look at a ratio of 1.0 or higher. Typically, you see a lot of lenders looking at 1.5. I would say if you're dealing with a particular lender, ask them what exactly it is that they're looking for, and then you can meet those expectations. Now is where I'd look to an activity, direct them to the balance sheet, and work through the calculation of the quick ratio using the example on the balance sheet. So you can work through your current assets of $60,000 less the inventory of $20,000. On the other side, you have your current liabilities of $35,000 and comes up with a quick ratio of 1.1. Appropriate borrowing, interest coverage. Let's look at the interest coverage ratio. It is, by definition, operating profit over interest payments. These items are coming from your profit and loss statement. And operating profit essentially is your gross revenue less your cost of sales and your operating expenses. And interest payments are exactly those, your interest payments on your loans payable. The interest coverage ratio is to determine whether you have enough profit to cover your interest payments. Commonly, you'll see the interest ratio wanting to be 2.0 or higher, and that's usually preferred by lenders. But again, go back to your lender and ask exactly what they expect and what covenants they may have. Now, let's look specifically at an example. If you take a look at the screen, an example can be if you had an operating profit of $9,167 and your interest payments were $750, you would have an interest coverage ratio of 12.2. Looking at appropriate borrowing, your fixed payment coverage. This is a little different than your interest coverage and looking at actually your fixed payment coverage. So let's look at the calculation itself. So first you have your operating profit plus your asset lease payments. That is divided by your interest plus your principal payments on your loans plus those asset lease payments. What you can determine from here is, are you able to have enough liquidity to pay or cover your fixed payment? So this is really looking at your lenders, looking at whether you can cover your payments. Typically they'll look at a ratio of 2 or better. It's preferred by lenders, but again, go back and ask your lender specifically what they're looking for. Let's take a look at an example just to run through the numbers. So if we had operating profit of $7,167 plus our lease payments and a loan of $2,750 plus our lease payments, those two net out, we'd have a fixed payment coverage of 2.6 times for our coverage ratio. Now let's look at adequate capital, the debt to equity ratio. So the debt to equity ratio can be defined as total liabilities divided by owner's equity. These figures are taken from the balance sheet, and you can see a calculation at the bottom of your slide. If you had loans of $200,000 and had owner's equity or owner's investment of $100,000, you would have a debt to equity ratio of 2.0. It really measures how leveraged you are in the business. So how much loans do you have versus the actual owner's investment or equity in the business. If you have a capital intensive business like a heavy manufacturer, you'd likely have a heavier ratio as you're spending more, taking more loans to pay for some of that equipment. Lenders typically prefer a lower number, don't want you to be less leveraged, usually 2 or less. But again, if you are working with a lender, ask what they're looking for and what they expect when you're calculating this ratio. At this point, I would turn to the audience and ask them to go through the calculation based on the basic balance sheet they've been provided. You can walk around and talk to them individually about it, come back up to the front and go through, ask if somebody has the answer and can walk through it, and then you can walk through it basically showing them on the page itself so that they understand the calculation. So for instance, you can say looking at the calculation of the debt to equity ratio, looking at your basic balance sheet, you have $60,000 in total liabilities. That's divided by $40,000 in total owner's equity, which results in a debt to equity ratio of 1.5. Adequate capital. Working capital. So working capital is defined as the difference between your current assets and current liabilities. So looking at the calculation, you have current assets less current liabilities equals your working capital. Basically, this includes your current assets may have your cash, inventory, receivables. Your current liabilities have your payables and any other current items you may have. This shows the liquidity or the liquid assets that you have for the business. So if you have certain assets and you can pay off those liabilities, that remainder is what you have, or that working capital that you can use. The higher the working capital, the better the business is to meet its operational and debt obligations. At this point, I would go back to the audience and have them recalculate the working capital using the basic balance sheet. And you can walk around or choose to stay at the front and calculate it because it's a fairly simple calculation. So it may go as such. trend analysis, growth rates. So here we want to walk through a calculation of the relative change from one period to the next. So not just looking at a certain point in time with some of the analysis we've done in the past, but looking at a change over time. So the calculation goes as such. Looking at a growth rate, you take the ending value minus the beginning value divided by the beginning value. This is also known as the percentage change. So if you're looking at your balance sheet, you may have your comparative numbers and your current year numbers. If you want to calculate what your percentage change is, you can look at these growth rates or your percentage change. Really what you're looking here is for trends or trends analysis. For instance, with my clients, if I see accounts receivable increasing, but their sales are decreasing as a percentage year over year, I may see that they may be having some challenges with their accounts receivable collections, and something to look into a little farther. Really, these percentages are to show you where there may be a concern or an issue. Trend, a tale of two companies. Here you can see we have firm D, accounts receivable, and firm G, accounts receivable. At this point, it'd be a great time to direct the audience to the handout, the compare and contrast handout. I would break them into pairs and have them talk about the two firms, be firm D and firm G, and contrast and compare the differences between the two. Once you give them 2, 3, 4 minutes to do that, you may come back up to the front and ask for some of their opinions and some of their observations they've made, and it should really get some good discussion going. This may take several minutes to go through this, but take your time and really listen to their stories. So now let's take a look at what does the bank look for. You may be working with a bank, a credit union, or some other type of lender, but they're lending you based on certain terms and conditions. They may have covenants that you may see within your financial statements, and again, that's very specific to each of the lenders. These type of lenders are relatively hands-off. They'll let you run your business, but may require periodic reports and meetings. You may have to send them financial statements at the end of the year or certain reports throughout the year, but they'll let you run your business as is. At this point, you want to have a certain type of activity. There are various different activities. I would look to what your audience and your type of audience and who's in it as to what type of questions you have. You can see in the notes there are various items that you can ask, but really what I'd look for is what type of lenders they have, what are their experiences, and what are certain terms and conditions they may have. You can cater it to the audience itself. So now let's take a look and see what an investor is looking for as opposed to a bank. So investors are really looking to be your partner. They want to work with you where a bank is lending you money. These guys are working with you. They're focused on participating, joining the business, and participating in the future growth of the business. They're joining at a point in time and they're looking to grow the business. They can add some expertise or add some contacts, maybe a strategic partner that you have. This can be very good and open up some great markets. Now, on the flip side, there are some risks. It can be very intrusive. They may come in, you may have always run your business in a certain way. You bring in a partner, and they may have a different way of running their business. So you have to make sure that it is the right partner for you. Also, if you have a certain type of investor coming in, they may expect certain levels of growth. As I said, they want to participate in future success. They may have certain thresholds they want you to hit. However, if you don't hit those, it may trigger some provisions they have that could be quite painful if you don't hit those. Personally, I have a client who partnered with a particular business, and they were able to add value to that business in the sense that they were able to open up some markets in the US, and it's now doubled the revenue for this particular client over the period of time because they opened up a market that they were never able to get on their own. At this point, you may want to ask the audience if they have any partners or investors that they have worked with and examples they have or they can share or would be willing to share with the group. Otherwise, look to your own experience and you may have a specific example that you may want to share with the group. It's always good to tell a story to personalize it, and it makes it more memorable for them. How to cure an unhealthy balance sheet. Now, you may end up in the position where you have an unhealthy balance sheet. It could have occurred over time. And let's take a look at some of the items that may have caused that. You really need to look at it a very skeptical way, especially if you have lenders or investors, and think about how they're looking at your balance sheet. So when you're doing this, let's take an approach you may want to take. You want to identify some of the symptoms that you have, diagnose the underlying problems, identify some of the contributing causes to those. You want to develop an action plan, forecast the likely results, and then revise that plan as necessary. Some suggestions would be, when you're developing that action plan, share those with others. You're not on your own, and you may want to share that plan and revise that plan. When you're forecasting your results, it is an iterative process, so you forecast one way, make a slight change, and see what the results of those changes are over time. All the little changes will help look to cure that balance sheet. You want to see the results of those. And you got to remember, this is always a fluid plan. As the reality and time goes by, things are going to change. So you want to make sure you're revising those plans and keeping up and changing those forecasts as time moves on. Some issues that I may have seen through working with clients, and some issues that you may want to look for, are excessive shareholder draws. You're seeing too many dividends being taken out of the business and not reinvested back in. Capital assets may be financed through cash and you're not properly leveraging yourself or taking on the loans that you need. You may have poor profitability where revenue is too low and you're not controlling your costs. So it could be two reasons. One, your revenue is not growing as you expect, or if it is declining, you need to really tighten up and control those costs. Another item from a cash flow perspective is paying your bills too fast. You don't want to let go of your cash. You want to make sure you're paying those over time and matching the cash coming in from your own customers who are paying you. And you want to take a look at your accounts receivable and make sure that you're putting forth enough effort to collect that and really bring the cash into the business. Some of these are really key issues that can help cure an unhealthy balance sheet if you're seeing those in your business. Another item is looking at holding too much inventory or simply holding the wrong inventory and holding it for too much time. Or if you have a line of credit that is simply too low to sustain the amount of growth that you have. You need to have cash to maintain growth and to grow your business, and you need to make sure you have an adequate credit line to cover that. So now I'd like to point you to some of the other resources that we've included as well. You'll see there's a glossary of terms which can act as a cheat sheet for you going through some of the items that we've covered throughout this presentation. Also, there's an implementation checklist. So you can use this as a checklist looking through your own balance sheet and seeing some of the items that you want to take a look at and make sure that you're covering off when you're analyzing your balance sheet. At this point, it'd be a good time to open up to the floor for any questions they may have, or if you get a very detailed questions, you may want to take that offline later. As well, you can let the audience know that if they have any questions that come up later on, you've perhaps left a business card that they can contact you or call you afterwards. Thank you very much for your time. It's been a pleasure talking to you about a healthy balance sheet and why it matters. Thank you and have a great day. You may have noticed that this is a fairly short presentation, just going through these slides. There are a lot of activities and discussions that you're going to want to have with your audience with this particular presentation. If you end up going through just the slides, you're going to be done very quickly. You'll notice at the end of each of these slides there are activities or discussion points. So as you're going through this, you want to manage and make sure that you're involving your audience as much as you can to make sure they're being interactive. It'll be more interesting for them, and actually it'll be more interesting for you as well. Just make sure as you're going through it that you're monitoring your time to keep the discussion moving. If there's a very complicated subject, tell that person you can take that question offline. You can deal with them at the end of the presentation. This should help make your presentation more interesting, more interactive, and more enjoyable for everyone.